Hi, everyone. Welcome back to another Capital Conversation. My name is Colin Day. With me today, Brian Potts. Mr. Potts, how are you today?
Always doing great.
Yeah.
It's a pleasure to be back on again.
You know, it's interesting because every day that we do one of these, I look outside and it's different kinds of weather. And it's the first thing that I always want to remark on. And it's cold and dreary for a lovely April afternoon here in Clayton, Missouri. We just came from Nashville, which was just cold and dreary, or at least I did. You were stuck here hanging out in St. Louis. But when I look outside and I think of the kinds of things that could be more dreary than the weather outside, it's taxes.
That's it, right? That's the
Yeah.
conversation? No.
No. That's exactly what we're doing. Didn't you read the memo?
I did.
Yeah. Today we are going to talk to you all about tax diversification and why it matters. This is tax season. As we are recording this, we are just a week out from filing taxes. Ryan, I will ask the question. Did you file your taxes yet?
I did.
Good for you.
I was an early bird.
Oh.
February.
Some people say you should file early because they get worried about, from a security perspective, someone trying to file underneath your social security number or something like that. I, on the other hand, preach the opposite, which is I'm going to wait until the last minute because, that's what I do. So it's going to feel so bad. But in any case, tax diversification is going to be the topic du jour today because I think a lot of people, because this is a sensitive time to talk about tax, it's important that we keep it in the conversation, and it really is an evergreen topic because at least in my life, taxes have been something that have been relatively unavoidable. I don't think you've avoided taxes either.
Not that I know of.
Yeah, legally speaking.
Legally, yes. I think taxes is a really interesting conversation. Luckily for you and I, we're not CPAs, so we don't have to talk a ton about taxes.
That's true.
But I think today's conversation specifically is tax diversification.
Mm-hmm.
I guess my question I'll just kind of tee you off with is what is tax diversification, and maybe what is it for clients?
Yeah.
How is it part of a financial plan?
Tax planning is one of the major areas, or at least a component of areas that financial advisors should be concentrating on for their clients. We go through the Certified Financial Planner program, learn about tax. You do a lot about tax. I thought tax was interesting enough that I continue to learn about tax, and that's how I got my enrolled agent designation. But tax diversification from a client perspective is really the idea that just like we preach diversification on the money that is in your account and how it's being invested, it's also from a withdrawal perspective and contribution perspective for that matter, how those dollars might affect your taxes throughout the year. So for example, we can keep it as simple as saying in your 401k plan at work, you might have a pre-tax deferral option or a Roth deferral option. So that pre-tax deferral option, as it's implied by the name, you're putting in money and you're not paying taxes on it yet. You're going to pay taxes on it eventually when you withdraw that money. And that's going to influence your current taxes because you're likely getting a tax deduction. I'm not including that money on my taxes now. I'm going to pay taxes on that later. Whereas a Roth contribution, we're kind of doing the opposite, right? So we're paying those taxes now, and we're doing that with intention to pay that now so we don't have to pay the taxes later. So just like in this very simple example, which hopefully I haven't lost people by verbally explaining this, the pre-tax contribution is a way of saying, I think I'll pay less tax in the future, so I'm deferring my tax to a later date. Don't want to pay them now. I might be at my highest earning years. I'll pay the taxes later when I withdraw the funds in retirement. Whereas with Roth, you might be thinking, I'm going to owe more in tax. There is certainly a segment of the population in the United States that believes taxes are only going to go up. And if that's the case, then you want to pay your taxes up front. That's where Roth is going to come into play. Pay the tax now, avoid paying the tax later. So from a diversification standpoint, what we're doing here is we're just splitting up the different kinds of money that we'll have available to us to eventually distribute to ourselves over time. Does that make sense?
Yeah, absolutely. And obviously the third bucket is just normal taxable dollars, which would be equivalent to like a brokerage account. If you put money in, you hold it for more than 12 months, you sell it at a gain, that's a long-term capital gain. That doesn't apply to qualified dollars.
Right. Right, exactly. Because, again, when we fast forward and we think about then the implementation of this, everybody's going to look a little bit different. But what we don't want is for someone to come to us in retirement and they only have one kind of money.
Right.
And for most folks in this scenario, this is going to be pre-tax money.
Right.
Because when they open up their 401k, maybe in the 80s or 90s when they first established it, they started to contribute. They got on a 30 to 40-year track of doing the same thing. Now when it comes to retirement, all their wealth is in their 401k in the pre-tax bucket. And well, shoot, what happens? Anything we take from that thing, we're going to add on to our income. You have one bad year, you're in a situation that well, it might not work out well for you. We're going to talk a little bit more about the ramifications of tax diversification in a second. So, Ryan, why don't you maybe coach us through a little bit about what that might look like from a portfolio perspective?
Yeah, absolutely. You alluded to it really well. With like 401ks or IRAs, for the most part, we tend to see a lot of pre-tax dollars, or tax deferred is another way to say it. However you want to say it, it's the same thing.
Yeah.
But when someone leaves a job and retires, for the most part, they probably were making some kind of a tax deferred election. Those dollars are then rolled over to a qualified IRA. As we are withdrawing those funds, they're then taxed at ordinary income. In a portfolio, it's important, though, we talked about the bucket approach in our last conversation, and kind of how we have different strategies for different time horizons within the financial plan. Albeit for somebody in like the accumulation phase, they may be adding extra money to an emergency savings account. The big important thing from a portfolio standpoint when it comes to tax diversification is making sure that you're really taking advantage of the rules that the IRS has laid out for us within these different accounts. A great example of this is, again, that retiree who maybe has deferred dollars. They may also have made a Roth contribution to their 401k. When they retire, they come to us and we talk about financial planning, retirement planning, the conversation around asset allocation and how is the portfolio going to be invested. We always take into consideration the fact that, if we allude back to that bucket conversation, that long-term bucket of money is money that we plan on spending in 10, 15, 20 years. Maybe it's at the end of your retirement. Maybe it's money that doesn't get spent and it's going to get passed down to the next generation. Based on those things, we want to say, well, which of the three buckets in terms of tax deferred, taxable, or tax-free is going to make the most sense for us to be the most aggressive? And in that scenario, it would be the Roth account or a tax-free account where we can take advantage of the fact that we know all the growth that we're going to accumulate. We can then pull out or gift tax-free essentially. And I think that's really important because for someone who retires pre-R&D, we need to make sure that maybe their taxable dollars are a bit more conservative because those are the dollars they're going to spend first in retirement. Where like the IRA might come in as like that midterm bucket of money where it's trying to earn a little bit more than inflation, but still a little bit more conservative than the Roth dollars or the dollars that we plan on spending at the end of retirement. So from a portfolio perspective, the different tax buckets are also going to be invested differently.
Yeah. And I mean, in terms of like the kinds of securities that you might hold in different kinds of portfolios, I mean, that might matter, right? If you think about what are the tax implications, not just now, but in the future. So I think about like holding onto a mutual fund in a taxable account. Well, for some people, that's not such a huge issue, but for some people, it's a huge issue.
Right.
I don't know if you have any examples that you want to give, but the one that I think of immediately is, if you've got more tax-efficient vehicles in certain kinds of accounts, they make more sense. It's why a financial advisor doesn't recommend holding on to like a municipal bond in your IRA.
In a qualified account.
Yeah, and for those, again, that are not familiar, municipal bonds, you might be spitting out interest, which is great for you, but the reason that people invest in them is because it might be tax-free.
Right.
But you put that in an IRA, and unfortunately anything that grows in that thing is going to get included on your income. So that kind of security is not appropriate. So that's the kind of stuff that is a little bit more nuanced, and as your advisor is building out your portfolio, well, I say obviously, but I'm hoping that they're thinking of.
Yeah, I think mutual funds are just, in general, when we talk about tax efficiency, most mutual funds aren't that tax efficient, especially active mutual funds that are constantly buying and selling individual securities. At the end of every year, those managers might kick off some kind of a capital gain. If you hold that mutual fund in a brokerage account or a taxable account, well, that's a tax bill that you're going to have to fork up that year. There's nothing you can do to circumnavigate it. If you had that mutual fund in a qualified account, i.e. An IRA or like a Roth IRA, you don't owe anything on those capital gains within that account. So to your point, there is ways to be efficient and to optimize the tax diversification from a portfolio perspective as well.
Yeah. And going forward and thinking about then the implementation of this and what it really means, it comes back to a lot of the stuff that Ryan mentioned, and I'll just revisit something that I mentioned before. The reason that we want to have intention with how we build out your portfolios from a tax diversification standpoint is what I call the one bad year rule, which is you might be retiring within the next couple of years, and if you are in that bucket, which again happens unfortunately quite often, where all of your wealth is in your 401k and it's all on the pre-tax side. Well, if that's the case, and you say, Colin, I need $3,000 a month to supplement my Social Security so I can live in retirement. And I say, that's wonderful. We can certainly set up with that plan. And we start to send out those payments of $3,000 a month. And a year goes by, and things seem to be going pretty well until they're not. And you have the water heater that goes out. You have a major expense like maybe your child is getting married, and your 401k is all you got to be able to afford maybe the open bar,
right,
whatever liquor package you're buying or whatever. You might be in a situation where you suddenly need a lot of money. And any money that we take from your 401k or your traditional IRA, those kinds of what we call qualified accounts, are going to get included at ordinary income tax brackets. And the tax bracket system that we all enjoy in the United States says the more money that we make in a given year, the higher percentage that we have to pay to the federal government. It may also apply to your state, depends on where you're listening to this. But from the federal side, we have that one bad year where we were pretty consistent in terms of what we were withdrawing out of our accounts. We knew what our taxes were going to look like, and then you have a year where you need an extra $20,000, $30,000, $100,000. And now we're in a different bracket. We're paying a lot more tax than we anticipated. We might be breaking the plan a little bit in what we anticipated for you because we need additional expenses. So again, one bad year is really why we preach diversification. Whereas if we had multiple different kinds of accounts, brokerage, Roth, different things to look at, we'd have a lot more flexibility.
I think that last word that you just said, flexibility, is the most important part when it comes to the financial planning aspect. Because like you said, we could plan whatever we want. We don't have a crystal ball. We don't know what could potentially happen. I mean, we always talk about setting money aside in an emergency or a cash bucket, and taking advantage of the fact that you have some security, but not everybody has enough dollars in their savings account at the bank to cover an emergency. So then you get into pulling from the IRA or pulling from the 401k. I think the other interesting part too then is you're almost double dipping, because now that you're pulling additional dollars from your IRA or 401k, you need to come up with more money to pay the tax on the fact that you're withdrawing. So then it kind of becomes this snowball effect of, okay, we're withdrawing for one thing, now we need to withdraw again just to pay the tax.
Yeah.
And it's like a double whammy, and it can really hurt our clients when they don't have the flexibility.
Absolutely. You just prolong the problem to more years than what you anticipated once that tax bill comes due. And I like that you said crystal ball, because the second thing that I like to remind people of is why we preach diversification is that we don't know what taxes are going to look like in the future. But I do know with pretty good confidence what they look like right now.
Yeah.
And what I do know is that the Tax Cuts and Jobs Act, which was passed at the end of 2017, basically reset the tax brackets from 2018 through the year 2025. And so we are kind of in these artificially low tax brackets, which has incentivized more people to do more Roth-related contributions, 401k, IRA, wherever it might be, 403b, 457, to those types of accounts, because we are incentivized temporarily to do so. And what I mean by that is that if we're paying less in tax, the burden of paying the taxes up front isn't as great. Whereas if we fast forward to 2026, when the Tax Cuts and Jobs Act is going to sunset, now we're at a situation where now we do have to pay a little bit more. But if I've already prepaid my taxes at a lower rate, it'll work out better for me. What we don't know, because again we don't have that crystal ball, is that this is an election year, and there's already fodder for whether or not that's going to be continued. And so maybe we're going to be in a situation where we'll enjoy these tax brackets longer. But because I can't say that for certain, and all I know is what's in front of me, I'm going to use that as an option. The third thing that I'll just mention very briefly is next gen planning. So you touched on that a little bit, thinking about, well, I'm putting my oxygen mask on first. I have the wealth that I'm going to be doing well with me and my spouse to survive retirement for 30 plus years. If there is a situation, however, where you feel like you have saved too much, which is super rare. No one's ever told me, Colin, I'm so mad I saved too much for retirement. But in the case where you might be in a situation where you've done well and you've invested well and you have wealth to be able to facilitate maybe the next generation, besides just doing basic things like gifting, which is a completely different conversation, we might be thinking about the kinds of securities that we're going to hand off to somebody and what we're spending. Right. So for example, do we want to really spend our Roth dollars now, or do we want to quote unquote gift it to our loved ones? Because if I've already prepaid the taxes and they inherit it once I pass, well, they don't have to pay the taxes.
Right.
Or do I want to spend money in my taxable account because I know that they might get a step up in basis, again, technical terms, we could talk about it later, but that it might benefit them so they don't have to pay as much on the gains.
So let me ask you, from a listener's perspective, maybe quickly, if I'm coming in and I want to work with Correct Capital or with Colin Day, and I am that person that put all my money in a 401k, and I put it all in tax deferred. And let's say I am retiring before my RMD age. So let's call my retirement 65.
Okay.
What do I do as a listener to maybe try to implement tax diversification? Because I know right now I'm super concentrated in the tax deferred bucket, and I need to get some money in the Roth or in the taxable accounts. What are some strategies that you can implement?
Yeah, well, the first one, of course, is that we can convert. We can convert pre-tax dollars into Roth. What that looks like is we are literally, well, probably in the case of a traditional IRA, taking that qualified money, and we're moving over portions, not the whole thing.
Right.
We're moving portions in time over. And the reason we do this in portions is because whatever we move over from pre-tax into Roth gets included on our income. So we want to be hypersensitive to this because, again, we enjoy a graduated tax system. You know, it's progressive, so the more money we take, the higher the percentage we pay to the federal government. So we want to do that within reason. Now, if you're one that's retired and you're sitting on a hill of cash, then that you are in the best situation possible. Because if you're living on the cash and you're not earning anything, well, you might not be paying any taxes as long as you haven't elected for Social Security yet. That's the Goldilocks zone that I talk about a lot with our clients to say this is the window of opportunity to do our Roth conversions. You might also say, hey, Colin, I'm going to do the Roth conversions, or maybe I'm going to move money into my bank account, so I feel comfortable with this, but maybe I don't need this money for the next 3 to 5 years. Well, that could be a taxable account situation.
Right.
Yeah, we have to pay the taxes on what we took out of the IRA. But now in the future, I might be paying 0% long-term capital gains, 15% at worst, and that might still be lower than your current tax bracket. So those would be some of the things that we would spitball and then determine, okay, what is the dollar amount? And then we work with your CPA, because we're not CPAs,
right,
to then determine, hey, how much do we think we can convert? How much money do we think we can move over so that we stay within a current tax bracket?
Like you said, like hypersensitive, there's a lot of things, there's tons of variables when it comes to like a Roth conversion strategy, or even a distribution strategy. Again, I think the moral of this conversation is having diversification gives you the flexibility to kind of pull different levers to put yourself in a better situation.
Yeah.
And there's not really more to it than that other than, try to build the diversification before you retire, but understand that if it's not there upon retirement, there are ways to get there.
Absolutely. You are not lost. You are not stuck in whatever you think you are. You're not mired in qualified hell, or however you want to call it. There are ways that that you can work with us as financial advisors or with your CPA to then determine what the next route is. And honestly, I could wax poetic about tax diversification all day, but we should probably call it there because I don't want our listeners or our viewers to have their eyes or ears bleed. So we will leave it there for right now. Thank you so much for joining us on another Capital Conversation. Let us know if we can help you. Please like and subscribe and share, and we'll talk to you in the next one.
The opinions expressed in this program are for general informational purposes only and are not intended to provide specific advice or recommendations for any individual or on any specific security. It is only intended to provide education about the financial industry. To determine which investments may be appropriate for you, consult your financial advisor prior to investing. As always, please remember investing involves risk and possible loss of principal capital. Please seek advice from a licensed professional. Correct Capital Wealth Management is a registered investment advisor. Advisory services are only offered to clients or prospective clients where Correct Capital Wealth Management and its representatives are properly licensed or exempt from licensure. No advice may be rendered by Correct Capital Wealth Management unless a client service agreement is in place.